welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, June 14th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we do show futures higher, but that could change. We got a big inflation report coming out in a little bit this morning. But currently, we do have futures up, Dow futures up 42, S&P 500 futures up about 9, NASDAQ futures up 57. So on a relative basis, we're seeing a little bit of strength in those NASDAQ futures. But wow, it's been a rough ride for the NASDAQ recently. It's been a rough ride everywhere in U.S. equities, but especially in those NASDAQ securities. We'll talk a little bit about that during the daily market recap in just a couple minutes. First, I do want to just go over today's agenda before we get started. So we're going to go through the daily market recap, start off as we always do, then talking technically, key ratios, sentiment, earnings spotlight, and the 3 you must see. Before we do any of that though, let me take you over to Earnings Beats. For those of you who are new, if you go to earningsbeats.com, scroll down, we have a free newsletter here. All it takes is a name, email address, hit that subscribe button. This is a 3 times a week newsletter coming out on Mondays, Wednesdays, and Fridays. We try to get it out around 8:30 a.m. Eastern, which is about an hour before the market opens. It's a very, very quick read, couple paragraphs and a chart. Just informational, educational, if you will. We have some who like to use these for trading opportunities. That's completely up to you. But we just focus on things that are important to us at Earnings Beats. So hopefully maybe we can add some things to your trading arsenal. We look at things like earnings, gaps, relative strength, trend lines, moving averages, candles, those types of things. But we do try to make it as educational as possible. I think you'll enjoy it. So go over to earningsbeats.com, make sure you scroll down and sign up for our free newsletter. Also, just want to mention anyone who is on our newsletter, when we have our free events, we reach out to the entire community and the entire Earnings Beats Digest community with room instructions for you to attend. So another great benefit there is that you can attend our free events as well. Okay, let's move on. Let's get this thing started because there's a lot to talk about. Really rough day on Wall Street on Monday. Your daily market recap, Dow Jones Industrial Average down 876 points. S&P 500 down 151. NASDAQ down 531. 4.68% on a percentage basis. Think about that. Almost 4.7% in one day. And if you look back over the last 3 or 4 days, we're talking 10% on the NASDAQ that's come off in just the last 3 days. So pretty brutal end of last week and start of this week. I think it is a lot of selling ahead of key inflation reports. Also, the Fed will be meeting. Their meeting kicks off this morning. We'll have an announcement, policy statement decision tomorrow, Wednesday at 2 p.m. Eastern. So all of that, I think, definitely factoring in here. Mid caps down 109 points, small caps 53, both of them down about 4.5%. Energy got hit yesterday. Energy, after getting up into the low 90s, now back to 84. Now, if you remember, that 80, 82 area was a key area of resistance where we finally broke through. So now we're back testing that from above. I think part of this could be options. We're going to talk more about options, but this is the one sector that has seen a lot of strength. So there's a lot of in the money calls. And as a result, we could see this could be part of options, at least in the energy area, pulling back. We'll see. But energy was the leader to the downside, down more than 5%. Real estate down 4.8%. Communication services, 4.7%. Discretionary and utilities, both down 4.6%. And you can see utilities made a fairly big breakdown below $70. This is a group not as strong as energy, but it had been uptrending. And, maybe still in the big picture, you can follow this low versus this high. But short term, I think losing that $70 level was pretty critical there. Discretionary stocks challenging the low that we saw at the end of May. Communication services broke down. Real estate broke down. Of course, as I mentioned, energy just now moving back down to test key support, 50-day moving average. But overall, really, really bad action on Monday. Every sector was down at least 2%. The best performer was consumer staples, a defensive group, which was down just a little bit more than 2%. All right, 10-year Treasury. I think this was the biggest story of all yesterday. 10-year Treasury yield jumps 21 basis points and hits 3.37%. That level right there, you can see it on the daily chart. Obviously, it's a breakout here to a 1-year high, but that's actually an 11-year high, which I will show you here in 1 second. But this whole move up since the beginning of the year, if you think about the S&P 500 and the fact that it's gone down so much since the first couple of trading days of January, notice it was the first couple of days of January that we took out that prior high on the 10-year Treasury yield at 170. That was kind of a big deal then, 170. We've doubled that in a little more than 5 months, from 170 almost to 340. So the problem, I think, with the market, there are number of problems, and we can point to whichever one you want to point to. I think the biggest problem with the market heading into this year was that it was simply poised for a pullback. I mean, we went up 115, 120% in about 21, 22 months. It was the biggest rally ever over 21, 22 months. Even if we look back to the pre-pandemic high on the S&P 500, which I don't know, was maybe 3,300, that move to 4,800, we're still talking about, close to, or maybe it was 3,100. I think it was 50% or maybe 55%. So even if we ignore the huge move down we had with the pandemic, that in less than 2 years, we were still up 50% or more, which is really a lot for the S&P 500. We had unusually low interest rates, which helped to fuel a meteoric rise in growth stocks. They went too far. And I was talking about the rotation before the bear market began. While the S&P 500 was at a high in January, beginning of January, I had already posted articles talking about how rotation was so bearish and how Wall Street was not believing in the rally anymore, and that we shouldn't believe in the rally anymore. All those things are well documented here on StockCharts back at the beginning of this. Well, now we've seen all the damage going on in the environment around us. And the problem is that most traders will look at those problems and won't be able to see the bottom when it hits. Just like they couldn't see the top when it hit. You've got to be able to look at these relationships, the intermarket relationships, the ratios. I'm going to talk about a couple of these in just a minute. And you've got to be able to think ahead. Use this information to help guide your future decisions before the market does what it does. Now, I know there are many of you out there that are saying, Tom, there's no way the stock market can bottom. We've got so many issues. Think about where the S&P 500 was, 4,800, and where it is right now. The market prices things in. You might think that interest rates at 3.4% or 3.37% are absolutely horrible. They're horrific. And this is awful. Well, historically, it's really not that bad. The problem has been the fact that we've gone up so fast. To see interest rates go from 1.7% to 3.4% in 5 months, that's a problem. Not the rate itself. 1960s, we were in a secular bull market. Rates kept going higher. I think rates could continue. I think we'll probably pull back, moderate at some point later this year, maybe stay somewhat flat in 2023. But I wouldn't be surprised if interest rates were to move up over time to 4.5% over the next few years. I don't think it's going to be this year. I mean, we might have a knee-jerk reaction. There's a lot of folks selling ahead of the Fed because the Fed's selling. I get it. That's what drove prices down or yields down in the first place. We had a lot of bond traders that were front running the Fed. They knew the Fed was buying bonds. So knowing that the Fed's got your back, why wouldn't you buy bonds? And so there was a lot of bond buying going on that sent yields down. We got the reverse in play now. I'm not surprised yields are going up. We've got an inflation issue. You can call it a problem. You can call it temporary. Folks are in both camps. I was calling it temporary over a year ago. Obviously, I was wrong. It was not that temporary because I thought it wouldn't last that long. And here we are still fighting it. The Fed's about to raise rates 3/4 of a point. You need to be aware of that. But I don't see this as a long-term problem. I really don't. Well, we'll see what happens. I think this is mostly pandemic driven. I think that this was a case of a serious imbalance of demand and supply. That's basically economics 101. I think the supply chain, some of the companies are now starting to say supply chain disruptions are beginning to repair themselves. That's a huge advantage. That's good for the bull market down the road, because once we get enough supply and we go into a recession and demand slows, all of a sudden we're going to have, in my opinion, the opposite of inflation. I think we're going to have deflationary pressures that are going to start to kick in. And I think the Fed's going to have to change its policy. But let's let the market tell us that. I think we're getting really close to a bottom. If we're not there, and when you get the VIX rising, equity only put call ratio rising, you get a lot of panic in the streets. I mean, we could easily be down another 10% on the S&P 500, 8 to 10%. I wouldn't be surprised. And it could be coming now. It could be coming this week. I don't know. Currently, we got futures up, so we'll see what happens today. But a big inflation report on deck here, coming out in about a little over 30 minutes. Again, I'm pre-recording this for the 9 o'clock airing. But we'll see what happens when that report comes out and how the market reacts and how everything trades during the day. And let's not forget, we got the Fed on deck. More and more folks thinking 75 basis point hike tomorrow instead of 50. Let's see how the market spins it. Is it good because they're going to do 75? Is it good because they're going to, this is a signal they're really serious about inflation, they're going to get it under control? Or is it bad because it seems like they've lost control and they're now trying to hurry up, catch up? I don't know how the market's going to react. We're going to find out. Anyway, 10-year Treasury yield, they're breaking out, but I want to show you the long-term chart. Look at the 10-year Treasury yield here. This was back before the trade war, kind of when all that trade war mess was starting with China, back at the end of 2018. That started sending yields down. And then the pandemic hit and we just took it another step lower. Now, I know, if you go back and you look at this and you connect these highs, it looks like we've broken out here. And I would suggest that we have. It was inevitable. I mean, we were at 16%. We went down to 0, almost 0% down below. You got to figure at some point interest rates are going to turn back to the upside. I mean, after all, it's been 40 years. So I'm not surprised. I think we're going to probably do more sideways with the 10-year Treasury yield than anything. I think we might make our way up to 4% at some point. Again, I don't think that's going to be this year. Maybe I'm wrong. I mean, we're certainly surging right now. We're not that far away. Rate we're going the last 2 or 3 days, we could be there in a week or two. But I don't think it's here. I think we're going to probably top out. And when we top out, I think that's going to be good for equities. I think probably, we might meander. I'm going to say between 2 and 4% over the next few years. That's kind of what I'm thinking. But we'll see. Anyhow, that's a long-term picture. I want to just show you that breakout. Okay. Talking technically, let's start with the S&P 500 because I like to always start with the S&P 500. I had written to our members Monday of last week, and I showed them, I actually forecast a candle back on Monday of last week. That was on the 6th when it was trading around 4,100. And I drew a candle very similar to the one that started this downtrend. And I said, beware this candle. So what I did is I just went out here and I did extra bars like this on the chart. So they gave you some extra. And we were in this period of consolidation, and I literally drew. Let me show you how you can draw one of these. If you go up here and you grab this rectangle and you do a fill, you can just do this. And so what I had done is I had dragged this out here and I just said, beware this candlestick. And then 3 days later, we got that candlestick. And I thought, that's pretty interesting. I mean, it's exactly what I had drawn. And I also had just said, be careful if we break out of this consolidation to the downside. So we got kind of the double whammy. And that triggered this tsunami of selling over the last 3 days. Volume's been picking up, been crazy to the downside. We did break below the recent low close of 3,900. So when I said I thought maybe we had a shot, that we were probably going to go back down one more time, here it is. It's upon us. Is this it? Well, we don't know for sure. I mean, if we were to stop right here and go up, I think there's still a possibility we go back down. However, if we keep going down, I think we could set sentiment at a point where this is it. This could be the baby going out with the bathwater, the kitchen sink being tossed in, and this could mark what I believe could be the major bottom. This move down, we'll see. Couple things I want to point out. Now, first thing, before I show you these next couple of ratio charts, first thing I want you to notice is the fact that we are at new closing lows on the S&P 500. We have now established a new closing low. We actually established new intraday low as well. Clearly the low is in, right? So here are a couple key ratios that I like to follow. So the QQQ versus the spider shows us pretty much growth versus value. Sure, you have a lot of growth stocks in the S&P 500, but I think we can probably agree that there's more growth in the QQQ than there is in the S&P 500. So it's one way of looking at growth versus value. This ratio topped at the end of November. Remember, the S&P 500 topped in January. So when we went to that final high in January, look at the money that was rotating out of growth and into value. Same chart here, relative chart. This is consumer discretionary versus consumer staples. Topped November 19th. In January, when the S&P 500 topped, look at this ratio. This is my favorite sustainability ratio. When the S&P 500 is going higher and this is going higher, I feel generally pretty good about the market. If the S&P 500 is going higher and this is clearly going lower, that makes me at least stop and think, what is going on in the market? Why is money rotating to staples from discretionary? If the S&P is going higher, that should be a signal of our economy strengthening. And if our economy is strengthening, discretionary should kill staples. Why is this changing? Well, now you know why that was changing. So I look down here at the bottom now, and remember, I just showed you the S&P is setting a new low. We actually have a higher low here on the XLY XLP. We have a higher low right now on the QQQ spider, but we don't know if the bottom's in. Again, when you look at that S&P 500, I mean, it's been 4 straight days now of big red candles, red filled candles. That's distribution, that's selling. So if we go down again today and have another big down day, do these two turn negative and follow suit? If they don't, if they start to turn back up again while the market's going down, that would be a huge bullish signal in my view. So we want to keep an eye on both of these ratios. Let's move on to sentiment. So I wrote an article last night and had it published this morning at 7 o'clock. So it was just published about an hour ago. And I don't normally do this, but this was primarily a reprint of an article that I wrote in Chart Watchers back in January. I think it was on January 18th. Now, I don't have the same readership in Chart Watchers as I do in my blog at Trading Places. So I grabbed that chart or that article and I just posted it here within my article for Trading Places. And I put here a link where you can click to go back and read the original article if you want. This is pretty much the whole article. Now, I talked about, this is one of the paragraphs. I mean, you can go in and when I went back and looked at this, because I was looking for articles where I've talked about sentiment back at the beginning of the year. And I tell you, I read this article and I was like, wow, this was pretty much spot on everywhere. And so I thought this would be helpful, I think, from an educational perspective of things that we look for. I mean, we don't always have tops, but when we start to get tops, don't listen to the media. Media wants to call a top all the time when the market's going up. You need to focus on the things that really drive market tops. And so I thought this was a great article to go back and take a look at. But throughout here, I made some really good comments. And one of them that I made was talking about the rotation to defensive sectors during that final move in December to all-time highs. And then, I talked about the fundamental red flags. We had rising inflation. We had the Fed turning more hawkish. And then the key here was Wall Street turned to defense. And my analogy was, when they play defense, they do it like the 1985 Chicago Bears. I mean, their defense can be stifling. And what I mean by that is that once Wall Street turns its back on those aggressive growth stocks, you don't want to be left holding the bag. And I think if you look at many of these growth names today and where they were, even back on January 18th, I mean, I was talking about it back in December, but even at this time, January 18th, if you had gotten out of growth stocks, your portfolio would be in much, much better shape. Look at somebody like Kathy Wood over at ARK Funds. She, I have a lot of respect for her because I do think that what she's, the research they're doing, I think eventually will pay off. But I'll be honest, anybody who saw, has been watching growth stocks being thrown out behind the shed and beaten behind the shed to just come out and just keep publicly announce that you're buying growth stocks. I don't understand that at all, honestly. Anyway, you can go through this article and, the CPCE is a big problem. There's no doubt it was a big problem. Kept talking about how all options traders were pouring into calls. The VIX was moving up while the S&P 500 was moving up. That rarely happens. That's a big warning because it's telling you the market's getting nervous, even though prices are going up. Usually the opposite happens. Normally when the market goes up, traders get very complacent. The VIX drops. Options become very inexpensive because the action in the market's very boring during a bull market. Go up 10 points here, we go up 7 points there, we go up another 9 points. Then we pull back 6 points, then we go up 9, then we go up 12, then we pull back 5. And it's just not volatile. It's not big moves. And so therefore, the pricing on the options is low, and that's what the VIX measures. So the VIX was giving us a warning. All of these things were adding up. Talked about retail traders being very greedy. I talked about the S&P 500 in this channel off the 2009 low to the 2020 pandemic low, connected those, took that same slope of the line, connected the highs. You can see we went just outside the range, 2014, 2015, negative divergence here, weekly chart. What happened? We struggled for better part of a year, at least 8 months or so. Look what we just did. Went outside the trading range, higher prices, lower weekly PPO. What happened? Well, last 6 months has been pretty bad. I was pointing to this 3,500 level back then. Before, we were still sitting at 4,500. I was talking about 3,500 when we were at 4,800. You've got to see these things before. It doesn't do anybody any good for folks, technicians, fundamentalists, whoever, to come out now and tell you you're in a bear market. What's that do? If you're already down 20, 25%, what does that do? Tells you, oh, by the way, it's a bear market. You've been losing a lot of money. You got to see these things ahead of time. Anyhow, just thought this chart was very, very interesting. Go back, take a look at it at your leisure, I guess. One last thing about options I want to talk about here, because this Friday is option expiration week. We have a big event tonight, Max Pain. We do it once a month. Options expire, monthly options expire the third Friday of every month. The Tuesday before the third Friday, we have a Max Pain session every month for our members to talk about what market makers could be up to heading into option expiration week. I think this is the week of the most manipulation that you're going to see in the stock market, because billions and billions and billions and billions of dollars are on the line. I want you to look at all of these options here on the QQQ. I set it to the monthly options. I wanted to see all volumes. That means any open interest, whether it's 0 or more. I just want to see all the strike prices. The options range, you know, we could do near the money. No, I wanted all of them. I want to see how much money is out on the table. Here you have the QQQ, where we finished at what, 277 yesterday. So if you go here, you'll see some in the money call options, but I want to go all the way up to now you get up to 270 and you start seeing a little bit more of call options on the QQQ. Here we are right now, 277. So all of these calls right here are in the money. You might think, wow, that's a lot. Well, it's a lot until I show you how many puts are in the money. 91,000 at 280, 44,000 at 285, 61,000 at 290, 38,000, 295, 102,000 at 300, 48,000 at 305, 60,000 at 310, 40,000 at 315, 32,000, 318, 46,000 at 320, 58,000, 325, 63,000 at 330, 35,000 at 335, 28,000 at 340, 29,000 at 345, 29,000 at 350, 30,000 at 365, 16,000 at 375. These are all the in the money puts. Friday settlement day. Which direction you think market makers might like to see the prices go? I calculated max pain on the QQQ yesterday at 316. We're at 277. I'm not saying we're going to 316, but what I'm saying is that there are over $5 billion worth of net in the money put value right now on the QQQ. And that is crazy. You need to join me today at 4:30 Eastern. Go to Earnings Beats, sign up for our 30-day free trial. We'll get your room instructions. You need to be there for this event. I tell you, this is the biggest event of max pain I think we've ever had, based on what I'm seeing in the market right now. Another thing, yesterday, equity only put call over at CBOE. When I went through and did the calculation, it was over 1 all day long. I mean, the sentiment is turning off the charts bearish right now, and that's good news for the market. All right, earnings spotlight real quick. Oracle came out. They're up really nicely this morning. They were in a downtrend. They did beat both top and bottom line. 3 you must see. I'm just going to go through real quick. Apple first did break down below this key area of support around 138. I think still 120s, 120, 125 could be in play for Apple. Then we'll go from there. Tesla hasn't broken down yet, but I would watch this area. I do think 600, 625 is going to be key short term for Tesla. And then Amazon is testing its double bottom from May down around the 103 level. We'll see if that holds. That's it for me. Listen, everybody have a great day. I'll be back tomorrow over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.